Good morning, everybody. Welcome to CPI Day, the biggest day since the last biggest day. Morning, lads.
Morning. Your mic sounds a bit weird.
Yeah,
You sound like you're deep in a well somewhere.
Deep in a well. Hang on, let me mute it and unmute it again.
You at the bottom of a bottle somewhere or not? Still celebrating?
Yeah. Any better?
Yeah. Not really.
Oh.
It's like yeah, it sounds like you're somewhere. How should I say it? It's not echo, but it sounds like you're in a barrel, let's say.
Oh.
yeah, you're talking out of a box.
It's okay. Let's start like that and see how it goes.
Yeah, so it goes. If I need to click off and click back on, I'll do so.
It's a bit better now, actually. It's a bit better.
Look at my settings. No, it all seems to be the same. Hang on.
It's okay. I think it's already a little bit better. I don't know what you did, but
yeah, okay. I gave it a stern look.
Oh,
Now you're gone.
Now you're very far away.
Oh, I don't know what's going on there. How's that?
Back to the old one. It's okay. Let's just start like that.
Yeah, let's crack on and see.
Good enough. Good enough.
Good. Okay, well, the PBOC cut rates for its 7-day reverse repo to 1.9% from 2% overnight. The Chinese state planner said they will steadily reduce loan interest rates. So this continued easing going on in China, which is giving one pairs another lift up. We'll look at those in a bit. Over to Japan, and BOJ's Ueda said that actual inflation of 2% would make price expectation 2%. Good maths there from him over there. Don't know what he's going on about that one, but there you go. BOE's man yesterday said that output data suggests strong growth ahead. And upside inflation surprises since May were in core goods and food prices. Here's a doozy for you. Said wage increases of 4% would be a challenge to returning CPI to 2%. Well, today we got some jobs data from the UK. And as you can see there, the numbers coming in much better. Claimant count falling 13.6k versus a rise expected of 21.4k. The employment change over the last 3 months up 250, so 100k on top of what was expected. The unemployment rate coming in much better, was expected to rise to 4%, came in at 3.8%. And back to her comment of wage increases of 4% will be a challenge. Well, wage increases were 6.5%, trouncing expectations in the prime number, and strip out bonuses were even higher, 7.2% versus 6.9 expected and 6.8 prior. So well above her 4% target anyway. This is due to a lot of these wage pressures that we've been talking about over the last few months. Some strikes getting resolved, higher pay awards coming in from that. We've still got some strikes ongoing, particularly in transport. So there's still more wage pressure that should come through the pipeline when those get resolved as well. But really big wage numbers here from the UK. Take inflation into account, and they're still negative on the wage front. But if inflation does start to come down, then that's going to be a little bit of a crossover. Now, a bit like the Fed, the next UK CPI report is going to come on the 21st of June, which is a day before the Bank of England meeting. The difference there is that a hike is expected, but those CPI numbers could mean we see a change in expectations for further hikes after the next one, so after this meeting. Still with my forecast that the BOE are going to 5% as a minimum. The market, in fact, after the data, is now expecting a peak rate of 5.7% by February next year. So that was a rise of 12 basis points on expectations. So they see 5.7% by February next year. I personally wouldn't rule it out, but we may be getting to extreme levels of pricing that way. If we see levels around 6%, then I think we might be getting towards, as I say, those extreme levels of pricing, and then that's when I might look to fade some of those moves. But for now, the data is still particularly strong in the UK in the jobs market. A little blip last month, I believe, but we're back on track now. As I say, those wages really are cruising. Guys, we've been talking about this for months, haven't we? These wage rises coming through the UK. It's going to keep a fire lit under the Bank of England, isn't it?
Theoretically, yes. And we've been talking about the UK kind of being, I don't want to say an outlier, but being on the top side in terms of inflation and potentially rate moves needed. And this is one of the main reasons why I've been saying for weeks that I think the sterling should be performing better than most of the other majors this year, for the rest of the year. Obviously, a strengthening pound, which I think it will come, will be a little bit of an offsetting move. So, when your currency strengthens, that tends to lower your, it's not inflationary, let's put it that way. But meanwhile, when it weakens, it is inflationary. So that's going to be a balancing force. But overall, the Bank of England would love to stop hiking, but they can't. They really can't. And out of all the major three or four, let's say put the Bank of Japan in as well, but they're never going to hike. Out of all the major central banks, I think they're the ones at most risk of continuing to hike because inflation is high and also wages, like you said correctly, are still high, which brings second round inflation effects. That's a problem. So, and also it's also a country which is not self-sufficient in terms of energy. So it's relying on external sources for oil, etc. In contrast with the US, for example. So it's another reason why I think there's going to be continued pressure on the Bank of England. And that's why I still like the pound.
Yeah, Kay, what are your thoughts on that data this morning? Similar, mate. I mean, don't change a winning team. I've been saying for weeks that the sterling is a bit better than some other stuff, and I'm just continuing the same path. Data are better than what people would have expected. Escaping recession, getting a better labor report, wages, you name it. We knew, I mean, it was kind of to be expected, those wages, right? Because there has been, those who demanded the wage increases haven't got everything that they wanted. Some were asking the young doctors, I think, was it 35%? They won't get it, but it had to be expected that those wages would remain sticky to the upside. What is encouraging for the economy is that including bonuses and things are also staying up. So yeah, I think Bank of England has to go on, and but it's supported by the data. It's not only that stupidly high inflation. I think it's supported by data, and that to me for a currency is the most important. I've been talking about that many times. You can have high inflation, but if you have a shit economy, it's not going to help you at all, right? So, but this I think is still supportive for the sterling.
Yeah, very much so. It's always a case with the UK. People like to bash it, and none more so than people actually in the UK, the press and everyone else. And we time and time again we confound what the analysts and experts tell us is happening over here. But yeah, been saying it probably the best part of the year that we're going to see really sticky inflation in the UK. It's a different beast to a lot of other countries. And yeah, we'll see what happens in that big CPI report next week, and that might cement some expectations for the Bank of England. Right, not a lot on the headline front actually. So the only other thing I've got really is that to geopolitics is that the US is preparing evacuation plans for American citizens in Taiwan. This was a story coming from some sources in the US intelligence, saying that this has been underway for at least 6 months, but it's heated up over the past couple of months or so, according to a senior US intelligence official. So all these tensions with China, the US are putting things into play in case something happens around Taiwan, which is a constantly bubbling situation. So that's just something to be aware of on the geopolitical front. And that's it for me. So it's been really quiet. Everyone's waiting for this bloody CPI report later from the US and what it means for the market. We do have, I'm keeping half an eye on the news wise, because we do have the new BOE MPC member Megan Green speaking in Parliament at her confirmation hearing. She's been a bit waffly at the moment, but one comment she did come out with, she said, if you engage in stop-start monetary policy, you can end up with a worse outcome. So that might be related to, the fact that some central banks are paused and then forced to hike again. So that would indicate she's perhaps in favour of keep going with hikes until you get to your level and then pause. But I'm keeping an eye on the comments there. There's not been too much come out that gives us any real indication of whether she's a hawk or a dove and what she wants to do with rates. We'll keep an eye on that one. You guys got any news you want to throw in?
Well, there's, as you say, not a lot happened. The thing about Green is that she can't be more dovish than Dingra, right? That's going to be very, very, very difficult. Now, just one or two things. So yesterday we had those bond auctions out in the US. So we had anything, a bit of everything from the 3 months, 6 months, 3 years over to the 10 years. Apart from making the Treasury pay up, it does not seem that there was a big action around it. So that's for the time being, and it's really we saw the yields really push up a little bit. It's just the bond sharks, I think, wanted the Treasury to pay up, but we haven't seen any big surprises on either of those bonds. So for the time being, the first bonds that they issue, they are going, let's say, not brilliantly, but relatively smoothly. I was saying for a while that we have to see where those, if those money funds, those people who have parked money in the RRP are willing to give some liquidity to the Treasury. So it's still early days, but it does seem, since there are no big surprises, that it may be the case. So we may have to, going forward, keep a close eye on what's happening in those with all that cash parked in money market instruments, and see if they want to go to the bond auctions. That is one thing. I think we have to just mention it quickly. There's a bit of M&A going on between Switzerland, Glencore, and Canada's tech resources. So Glencore wanted to buy the whole lot for about $23 or something billion, but now they're buying only the coal business for $8 billion. And it may be something that is going through in the Swiss franc right now, barring the fact that the market is trying to anticipate the higher interest rates by the ECB. But Swiss is a little on the defensive. I think if nothing else, one may have to do a little bit with the other, okay? Because we saw the euro Swiss started to rally once yesterday. Glencore kind of announced that they were going to buy that business. So keep an eye on what's happening in Swiss. It may be a one-day effect, an M&A trade going through. Look at it for the viability of this move. It may be just a one-day move here.
Yeah, thanks, mate.
Yeah. For the rest, I haven't seen anything else really. The rest is more like very much all opinion pieces about who should do what and what's going to happen after today's CPIs and the central banks.
Yeah, it is. That's really it. It's been a load of Bloomberg, Reuters, M&I, all opinion pieces on what's going to happen, and I won't bore you with all those. So let's get stuck into the prices. Sorry, Stel, did you have anything you wanted to throw in?
Nope. You can keep
Good.
going.
Well, dollar China keeps on ticking up. Looks to be on a proper grind here. This is becoming my pair of choice really for trading any sort of dovishness or less hawkishness from the Fed, given that China's still easing. It's going to keep pressure on the yuan. I'm looking for a dip in this one if there's any, US news that sends dollar lower. If this one goes down, you're in some of this, aren't you, Kay?
Yes, sir.
Good stuff. Where are you in from?
Sorry?
Where are you in from?
712s.
Very nice.
Yeah, I've let a little bit go, and I'm probably going to let a little go right now, actually, just ahead of the CPI in case we get a low one to pick them up lower again. But this one will be probably one that I'm not going to say explodes, but could go markedly higher if CPI remains sticky.
Yeah, no, I agree with that. We're getting up to some decent zones up here. We've got this zone around the sort of 16s to 19s and then through the 20s. And get through that, we might even be looking at these prior highs up towards the 730s, 737s. Which could be significant because it was pretty much as we hit those highs that China officials came out and politely said enough is enough, and it was a one-way trip down after that. So it's not one I want to buy up the top. I don't want to buy into the highs, but if we get a decent dip, I'm going to look to maybe get in some positions, some longs into that, and see where we go from there. And as we like to say, the trend is your friend, and it's continued to trend higher. So nice grab for UK. Giuseppe saying about the euro knock short. Actually, I can't claim that was my call. I got in the trade, but that came as watching analysis from Kay and Stel. We've been talking about it for weeks and weeks. So I was just jumping on their bandwagon really. Unfortunately, it didn't go as well for you as well for us as it has for you. So well done on those profits there. What would a probable squeeze look like in that situation? 200 pips. It's hard to define squeezes really. It depends on the volatility of a pair. A squeeze in something like cable or euro dollar may be, 50, 60, 70, 100 pips. It depends on what sort of squeeze it is, long term, short term, whatever. For the knock, you're probably looking at maybe 3-4 big figures for a squeeze.
At least.
Is that what you say, Kay? Is that sort of, given the volatility in these sort of pairs?
A squeeze, if you look at how oil's moved, I mean, if you look at the reaction that we had, I can show the Noki a little bit later because I had a bit of position while you were off. Took a few pips out of that one, but no, you're not looking at 100 to 100. A squeezing Noki could be 500 to 1,000 pips. This is like 1% in the Norwegian kroner can be done. It's not an emerging currency, but the liquidity in Norwegian kroner is overall not that great. So if you have a squeeze somewhere, you can look at 500 to 1,000 pips. I mean, we printed 1150s last week or so, and now we are back already at 1167. So that's already 1% higher than from where we were. So yeah, I mean, you have to be careful when you have a Norwegian or other emerging positions. You can squeeze a lot more than a couple of hundred pips.
Yeah, exactly. It's all down to the numbers. These we're talking of big figures of 11, and then you still got 5 figures after that. So yeah, you're talking big figure moves here. Like Kay mentioned, down from low 5s or 1150s up to 1167s. It's big on numbers wise, but not so much on the percent wise. But as you trade per pip prices, they can be big. So that's what we're going to look forward to on that one. But well done on catching that short, mate, and getting back in. Good profits there. And if I'm not making, I'm happy that someone else is. So well done for that one. Not an awful lot going on elsewhere. Cable's been walking pillar to post, nudged 126, then nudged below 125 yesterday. Now is all the way back up again. And part of that is down to the data this morning, but it was already bouncing back from that one. So it's doing its normal walk around there. I still think this has more chance of going up than going down. I think the dips, again, any dips you get in this one on USD strength through the data or the Fed is likely not to last, because it does still look like it wants to go higher on that one. Euro dollar's the same, having a little look around this 108 level, stuck its nose above, holding briefly, barely above the big figure at the moment. Again, this is one that looks like it wants to go higher, irrespective of what happens over the Fed. This is another one I'm going to be looking at for a potential outcome. If we do get something hawkish from the Fed or strong CPI data, if we get a move down to these sort of lows again, maybe look at a little long just to run into the ECB. We'll see what happens. I've got a few pairs that I've ticked boxes for various scenarios over the Fed and the data and whatnot. But all the rest, just a bit of waffling around, and I'm not expecting any major moves in any pairs until we get some of this data coming out. CAD had a bounce, got up near 134, ran out of steam. Now it's sort of sitting in the middle of this last few days range that we've had here. So there's lots of things that are all pretty much undecided, and unfortunately that's the way markets tend to go when you've got big data and big events coming up. Gets to a point and then markets just go a bit flat. Aussie dollar still keeping a bid in it, but not quite ready to have a look at the 68 handle. That was a level I was looking at, but I'm not going to probably touch it if we're close to that over the CPI. I'll look to react afterwards, see where we are. Have we broken it? Have we not? What's the news? Take it from there. Euro sterling again had a little move up to 86. Again, the data sent it back a bit low in the UK. I still fancy this one for a little bit of a sell onto the BOE after the ECB. So I'm looking for a hawkish ECB, or to at least maintain their current rhetoric. If that gives us a lift up higher, 86.5s into 87s, I might get into some shorts to run into next week's Bank of England, because we'll switch focus from obviously the ECB to them. Stel, you got anything you're looking at in particular today?
Ahead of this CPI, no. I mean, there are a few instruments which are near important levels, but it's such a potentially binary event. Anything weaker than expected, I think, will most likely call the Fed's going to pause for sure now, or skip, let's say. But I think anything weaker, if the trend looks like it is stronger to the downside in inflation than previously expected, I think that's going to really nudge them towards pausing completely. On the other hand, I think it's going to be a pretty violent reaction if we do get a higher than expected. So we're expecting 4.1, I think, year on year on the headline. If we get anything like 4.3 or above, that's going to put the brakes on the markets, and I think that's going to bring some quite violent reaction. So either way, I think most likely we're going to get a reaction and some kind of resolution in quite a few instruments, including silver, which is the one I'm always looking at most closely, which is close to that 24.50, but not quite there yet. And we also have to remember, let me pull up the Fed Fund futures just to see what we are pricing. But from what I remember, we're pricing nothing until now. We're pricing flat rates until, let's see, January. So yeah, December and June Fed funds are flat. So we are pricing a little bit of a cut, let's say, hike, let's say, but then we're pricing it all back off by the end of the year. So net for the rest of the year, we're pricing nothing. And then going forward after that, so January, February, March. So we're pricing one cut by roughly March, and then another one by May. So we're pricing 3 cuts next year or something like that. So this is the kind of the part of the curve that I think is going to move. So if we have a stronger than expected CPI, you can expect all that to be, or a lot of that, those cuts to be taken out. I don't think this year, what the market's pricing for this year, I don't think we're going to see lots of movement. Obviously, if we do get one hike, the timing of that could be, we could it could get moved further out, or maybe it depends. But I think one hike this year, I don't think they're going to do it. But obviously, if inflation comes in higher than expected, they probably will have to. But then the bulk of the movement for me in terms of rates is going to be for next year, which is pricing a lot from the Fed. I mean, they're expecting a number of cuts, and I really don't see how the Fed's going to be cutting this quickly, barring an extreme event, market panic of some sort. Otherwise, I don't see how they're going to do that. I really don't.
Yeah, that or a complete collapse in the data and stuff like that, which is showing no signs. There is some weakness, as we've been speaking about, sector divergence. But for today, I think that, as usual, the core is going to be more important than the headline, because if the core dips down, if the headline dips but the core stays as last month or even goes up, that's what the market is going to focus on more than the headline. And Mike's asked, what about CPI below 4%? I don't think it matters. Again, it's how we are leaning going in. The market is expecting an unchanged Fed, expecting a pause. So any data that confirms that call we're already sort of pricing it. So the shock is going to be if they are forced to turn and hike, and that's going to be on the back of the data. That's going to be the biggest price reaction. So if we do get CPI coming in, 4.1, 4%, that's a significant drop either way. If the core comes down more than expected, that's going to cement the move for a pause in the market's eyes. You probably see maybe a bit of a confirmation, bit of pricing. Some of those sitting on the sidelines who may want to be selling the dollar, they may step in and position themselves ahead of the Fed. But that's the way we'll be leaning into the FOMC. So anything hawkish or a hike after softer CPI will be a big shock to the market. So it's always how the market is looking going into an event. If it was looking more hawkish and we got soft CPI numbers, you'd get a move the other way. So that's the way to look at that one. Kay, did you want to have a little look around?
Yes, sure. Let me. Okay.
Oh, hang on.
Ready, Freddie.
Okie doke. All yours.
Right. So first of all, I'm not expecting. Well, I mean, I'm like everybody. I expect CPI to continue to come lower, but then it's going to be what is weak and what is sticky, right? So that's going to be your main problem. So I'm looking at it from a couple of ways, because as usual, you can trade dollars and you can trade crosses. And I'll look at a couple of the possibilities, let's put it that way. So as you can see, we're turning around this 2-year zone here in the 450s today, and that's going to be your first dollar driver for quite a few pairs. Let's say for most pairs, barring the yen, which is very much tagged to the 10-year, anything 2 to 5 years, those moves are pushing models to do stuff. So just a little bit of inside info on how some of those FX models work, correlation models work. So we're going to have to look at the 2 years, and that's going to be important for the euro dollar, for instance, and stuff like Canada, probably the mix perhaps a bit longer, but it could have an impact. So look at what's happening after CPI, 463, 65 on the twos, and then on the downside, this is too close. This is just going into the price instead of the price coming to the trend line. I think it's 445. So you got like 20 BPs for the short term. Okay, I'm just talking about this CPI here and what then the expectations may be priced for tomorrow. If we start to go below 440, then it's likely we are going to go down to 4.25. We have seen these kind of moves on data. Okay, so I mean, don't be surprised if again the market goes on a little bit of an overreaction or so right after the CPI. So if you get through 465. I think they could make some firewood out of this 475 as well, and we may go back to this level here in the 480s. That for the 2 years. Then for what's going to be important for the rather for the dollar yen is the 10 years. So in the short term, we've seen this little bit of a triangle unfold. 380, 382, stretchy to 385, but then the important zone here is going to be around 390. If that starts to go, that means that CPI is much more sticky, and especially the core. This would be a bit of a shock, I think, to the market if we take this out. I'm not sure we can. We can get, because there's always three possibilities in a number, right? You get as expected, a mild one, but then you can get like extremes, right? So if you have an as expected one, I think we are going to gravitate here. And as expected one will also mean lower, okay? So that's the expectation. So it could be that the 10s are going to rest back on this level. But if we get an as expected one, I don't see too much of a reason to start breaking it. If you get a real sticky one and the market is forced to take this one out, then I think your dollar yen is going to really take off, because as we've already said a number of times, the expectations for the Bank of Japan are still for them to leave monetary policy unchanged. We will come back to the Bank of Japan because it's still a few days away, because there's a good few possibilities what they could talk about actually. So if we get like a bigger drop than expected, expect these 360s, 363, 364 to be tested. It's been a traffic zone a good few times, and then keep an eye on what's happening in the 350s. If that would go, then really that means the market is starting to fiercely reprice whatever's going on in the US. Again, get a normal one, I would say, according to expectations. I think it may be more rangy than anything else in the bond market, because we can't forget that that Treasury still will have bonds to sell, but then market is already going to think about the FOMC. Euro dollar, we are on it, 108, figure 10, it's where we are. Market doesn't really like to own too many dollars going into the CPI, into the FOMC, and then the combination with the ECB, because the ECB is expected to continue to hike. So that's basically the reason why we are here. It should have been an important level, but then I think it's going to be relatively important on whether we close above or below. If you close above, then we probably going to be heading towards 109, right? And perhaps a 61.8, 109.20. That's on a weak CPI. If CPI remains sticky or surprises to the top side, I think we are going to retest 107.25, 35. That's all within the possibilities right now. I know quite a few people are actually hoping for a setback here to try and grab some for then an ECB trade later on Thursday. So this could get quite interesting here around 25.35 in the euro dollar, 107.25.35. If you would get a setback there. What I actually did, and it's a little contrarian to what the market is doing right now, but I don't want to have any cash. But I told the people in the room this morning, I did buy a bit of downside, bang on this 107.30. It's a cheap chip on the table. Instead of having cash, I bought a downside option, and I'm actually hoping for it to come here, manage a little bit of it, and then see what happens over the ECB, you know. And if I could get it down there, it would be nice, because then I can actually play both sides of the market. I think really this is going to be relatively important if we close there on if we are close on the ECB on Thursday. Cable is one. after this morning's job report that really should get bought if the CPI really undershoots. This is one of my instruments that I'm looking at, since I'm relatively positive on what's going on in sterling. This is one that really could shoot. We stopped bang on the 78.6 yesterday, and then went all the way back down to 124.90 on the support here. So that's basically your range you're watching, 126, 124.90, and then you got a few kickers here. There's a trend line here coming in around 106.20. If that goes, then I think cable should at least go and retest 126.75.80 on a weak US CPI. Your underside is well, close to home, but that's too close for comfort, 125.35. But then it's really going to be your 124.90 figure, and again below there your 124.40.50 magnet. That's in case US CPI would overshoot. But then on this one in particular, I think we may find even more deep buyers than possibly on a euro dollar. But there may be better instruments to trade sterling than to trade cable in case of an overshoot on the CPI. Dollar yen ranges ever tighter. Bigger picture. No change for now. We're in bang in the middle here. This triangle now is starting to look much too tight. Okay, it's 140 on the top side, bit of a psychological level. But I think if any instrument could really take off on a stickier, higher CPI, would be this dollar yen. I think then 140 may be toast, and we are going to go back to 141, and especially with the Bank of Japan expectations, if we get a real sticky CPI in the US. Why not, trade 142 before the Bank of Japan, before the end of the week. But if we get a low one, we know that the US yields are going to come down. We know that the dollar yen is a very well correlated with yields. So we should break. I think the 139.25 2025 is far too close. We're gonna have to look at this one here, the prior low, 138.75 80. That's going to be your key, I think, on the downside. If that goes, depending on how much the CPI misses, we could go back another big figure, probably down to 137.70. Dollar CAD. I think this one is also going to be one that could be more vulnerable to the top side on a sticky CPI. Of course, get a bad one, there must be enough stops below 133 to get it out of the way, and then we reassess what's happening if we get anywhere down to 132.65, 132.40, 30.40. But if we get a sticky CPI, this I think could be a candidate after the Canadian jobs report, negating some of the Bank of Canada moves. For a bit of a test higher perhaps, and solidify this whole range play or wedge or triangle play, you name it. This one could be a little bit interesting as well on the US CPI. Aussie, we've broken this trend line retest, and then we shot up 25.40, which I was watching also. Broken, bit of a retest, and now we are trading around 67.75. CPI on the shoots, this should move gradually up to 68.15.30, I think, and then we'll need to reassess a little bit on this Aussie because China being not doing too well. We'll have to look at what's happening in the commodity sphere to know whether this has more legs or not. If we get back below 67, I think the party may be over. That should be on a sticky CPI. So that's your two scenarios. Kiwi trying to make up its mind here around 61.40. We're actually bang on it. So just watch this one for a close. I'd say 61.40 up or down. That could be worth a % move on the Kiwi easily, I'd say. Okay, Right. Oh, and then the other currencies, as we see, the dollar rand. I was talking in the room about these low 1850s possibly holding, and they did for now. It's trading back above 1860. This one is going to need, I think, a sticky US CPI to start to move higher again. I think the market really washed out all its positions on the rand for now and is in a wait and see move. But 18.5 could already be good enough. I'd actually see a mild CPI, a retest of these 1850s, and then see what happens there. Because if it really holds, it could be a good level to start gradually climbing again. Yeah, I already covered the CNH. I'm initially looking for a 719.5 and perhaps a move up in the 723s if China continues to inject liquidity to cut rates, etc. And then let's have a look at the crosses, okay? Crosses. Yeah, Euro Sterling is still trying to make up its mind. It's trading around this 86 level. If and that's my own view, is correct that this is the last hawkish meeting of Mrs. Lagarde, and I'm taking a bit of a view there. I think we are going to find resistance somewhere around here, 86.25 max, 86.60, and then do another leg lower. That's my base view, and then we can come in those lower 85s where Ryan was talking about. But this one is an interesting one going into the Bank of Japan. US CPI will have an impact. Okay, it will have an impact on risk. And the risk side of CPI inflation data will also be important, because we've seen the equity market pushing through, keeping risk underpinned here. This one actually would need a relatively mild, without really collapsing out of bed, CPI, in my opinion, this sterling yen. And if we get that, then I think we can continue to push through after the UK Labour report, and a mild, without falling out of bed CPI should also keep the yen a little bit not under the cush, but relatively stable, and then the sterling may be doing the work here. I think we can stay in this channel or wedge or whatever. We can stay in this for a little bit longer. I'm looking for a little higher rates. So people are on the medium term. We've been looking at this, and this 150s, 175, 1065 we're in is relatively important. We could be on our way to 180 if this starts to hold. Okay, that I said I was going to look at some other crosses here. Euro, yeah. If you get a bad for risk CPI, which means a very, very sticky one, this Euro Aussie could actually go back and retest the 161.20, and there I will be interested again to get back into it. I think because ultimately I do think that post ECB we are going to be on our way to 158. But if the US CPI comes out very risk positive, I think this one, those commodity crosses could Aussie could get a little stronger and perhaps weigh a little bit on this Euro Aussie and actually go and test this 158 where we need to reassess what's happening in this pair. So about it really right now, yeah. We were talking about the Nokia earlier. So you've got the wider one, which is here, where for as long as we stay above 1130s, it's still positively oriented. But where I was a little worried, and I was a bit short Euro Nokia on the break of this channel last week, and I bought it back because I saw Brent and gas not really going a lot higher. And we couldn't even come and test under 1150 on the Euro Nokia. So I'm a little worried that we are in for a retest at least of this 11.72-75 zone on the Euro NOK, and that's going to be something that I'm going to keep a close eye on, especially on the ECB, but also related to what's happening in the oil market. I prefer not to take too much of a view on what's happening in the dollar NOK right now. Last but not least, metals, binary event to me, this CPI binary. 1980, 1943 for a starter, and then if you start to break under those 1930s, that would happen in gold. And I think we're on our way to small lower levels where I think there's a bit of a trend line coming in here, and that lies around 1915, 17 right now, but the main levels are going to be here, right, around, just call it 1900, if the US CPI would remain very sticky. Silver pretty much the same, levels 2370 for us below here, then closer to home 24 figure 10, and if we get a weak number, this could really start to take off, in my opinion. Back through 2440 we will have a first indication, but my level of lift off or cap is going to be here 2460-65. If that goes, I think then we are going to go higher, and that is it.
Thank you very much, sir. I shall grab back the screens, and just wanted to highlight something for you guys and girls. Let me grab that. Just if you weren't aware, I know some of you guys and girls were looking at our trader funding program. There's been some changes to the program, positive changes for you folks. Whereas the maximum drawdowns were 5%, and the daily was 4%, they've been raised to 6% and 5%. So it gives people a little bit more leeway to pass the assessment on that. Also, you now can have an option to go for 90% of payouts. So rather than 75% of the profits, you can now go for 90% of the profits, as you can see there. I've put a link in the chat room for you there. So anyone who was waving over to whether to join the program or not, or taking some time, you can now do that and get things slightly better in your favor in terms of helping you pass that as well. Also, don't forget, you can access our ForexAnalytix traders platform. I shall put the link up there for you as well, and you can do that with a special 20% discount for Forex Flow followers. So use my code FFL20, will get you off 20% of your subscription for the lifetime of your subscription for that one. So check those out. You can come and join us in the chat. And also with the TFP, depending on the account size you can get free access to the ForexAnalytix platform as well. So not much more to say. What I would say, just to reiterate, you know, we do have some big levels, and let's take dollar CAD as one example. You know, we've been talking about this 133s for a long time. You know, this channel down here, or this trend line down here, how it's played off the top as well. Solid levels, 136.50. It's all well and good until you get to these big events, okay? When you're this close to these big levels, you really can't trust them. And as Kay mentioned, what you want to do, and what I do, is look two things. If a level is broken over an event, look what happens after the event. If we break 133, do we come back and find it as resistance straight after? That'll give you a clue. Secondly, where we close. We could go to 132, we could go to 136 over this data and FOMC and stuff. Where do we end the week? Do we end the week still in the same range, or do we end the week outside of the same range? That's what you need to be looking at over these big events. You can't trust this level 10 minutes before the CPI or FOMC down at 133, and I wouldn't. But where are we afterwards? That's where you get your next big trading moves. If we're under 133 and holding, well, we might be heading down towards 130, who knows? But that will give you your next sense of direction. So don't trust the levels close to the events. Have a look and see what they do afterwards. And on that note, good luck around the CPI. Please don't get caught out. I don't want to hear any horror stories. I want to know that you've all made decent money. If in doubt, stay out. We shall find out tomorrow what went on when we do our post-data analysis on tomorrow's show. Thank you as always, Kay and Stel, for your valued input, and we shall see you boys and girls tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.